Hello traders out there in Traderland, D7 here with Grok Trade in sunny Tampa, Florida, and the markets are looking very interesting. We have a lot to go over, but we're going to start off here. We're going to start off with the 10-year, 2-year bond yield inversion, and the question is, should you care about the bond yield inversion? Should you care about it? The answer is yes. If you have money in the markets, 401k, IRAs, or whatever else, we do have recessions, and recessions are no fun to sit through. And I want to show you something that some of you guys know about, others may not, and I want to do a deep dive. Here's the long and short of it, that we have the orange line going up here. This is the monthly chart of the S&P 500. So this is what the markets have been doing. This is going back, for some time. These moves is the S&P 500. What you're looking at down here, this here is the difference between the 10-year bond yield and the 2-year bond yield. And in other words, this zero line is very important. If you are above the zero line, everything is normal. That means if you go into a 10-year bond, you're going to be getting a higher payment for that, okay? Because you're holding it longer, higher payment than a 2-year bond or a bond that's with a shorter term. The problem comes when the 2-year pays more than the 10-year. When that happens, you have an inversion. So you go lower than the zero line. And my friends, why is that important? The reason that is important is because historically speaking, every time we get this inversion, in other words, it drops below the zero line, we get a market recessionary pullback, and it's a dandy. Now, if we go back in history, I'm going to go way back. This was the beginning of time. You see the little dinosaur? The TradingView does this. I'm using TradingView charts here, and you can get TradingView free of charge. You don't have to pay for it. The links are everywhere in my description or whatever. If you look at this is go back in the 80s. But starting here in 95 and then going into 2000, right before 2000, okay, you'll see that we dip below this line. Do you see that where we dip below it? That's an inversion. And then we went higher. At that point, you'll see we had a nasty sell-off. Remember, it doesn't look big here. But if you look at this is in 98, nasty little monthly pullback, big little drop, and then it rallied higher. Okay, why? This was tech boom that we had, tech boom going into 2000. Then we had another inversion. Do you see this inversion where we went below this red line, the zero line? When that happened, we get this M here at the top, M for murder, and it was putting in a top. And then you'll notice we went higher than the zero line. That means it corrected itself. And then we get a sizable pullback in the markets. Now, when I say sizable, this was a dandy, guys. This was the technology bubble popping. And it lasted for a few years. From 2000, 2003, we put in the low, W for winter, for wow, for wonderful, W. And then we rallied higher after that. And then we get this inversion here. And if you look, when the inversion dropped and then it healed itself, we did drop after that. It was short-lived though. Do you see that? Very short-lived. But then it dropped again. So we look at this as kind of one area, even though it went down, up, down, up, down. This is kind of one area. Happened multiple times. What do you see up here? A big M for murder. And that is problematic when you see that in price action. But when you have inversions that correct themselves, and you'll see these vertical red lines, that is on the candlestick once it heals itself, meaning that it goes below the zero line and goes above it. When that happens, you have a better chance of the markets having a serious retracement. So this was going into 2007, going into 2008. We had the big recessionary pullback. That was a brutal, the Great Recession. That's what this drop was right there. And then it healed itself, and the markets, climbed higher and higher and higher. Okay. Now, what's fascinating, and let's just watch this together. Okay. I'm gonna push forward. So all I care about is when this thing gets near that zero line. See how we're getting near that zero line? Getting near that zero line. Now, right there, we're at it. We're at the zero line. The question is, are we going to go under? This is, we're in 2019 right here. We bounce right at it. We go higher. We just went lower. I mean, we barely went lower than that. And what happened was a huge drop a couple months later. See this huge drop that we had here? And that was 2020 drop. Can you guys, anybody tell me what this nasty drop was? It doesn't look really big here. This was the fastest trajectory drop that we've seen since the Great Depression. This was the Corona crash, and we only missed it by 3 days. If we had dropped 3 days faster, or 4 days, we would have beat the drop that we saw in the Great Depression. This was a nasty drop. Doesn't look that big on this chart in this large multiple decades. A lot of damage took place there with just the smallest inversion. So let's keep marching forward, and then all of a sudden we hit the line. Do you see this? We hit the line, we go back up, and then now we are inverted. Do you see that? Big time inverted. And what's interesting here is we stay inverted, and it's the deepest inversion and the longest inversion history has ever had. And right now, as of today, this month, the monthly chart is higher. We have, another week of trading to go. This could come crashing back down. But at this moment, I will add at the end of this month, if we stay above zero, I will add a red line. When I add a red line, our chances of a recessionary pullback go up dramatically if history repeats itself. And the SOM rule has already been saying we are in a recession. And guys, if you haven't been paying attention, the restaurant business is freaking out. They are saying that people are not coming in and buying now. A lot of arguments. Hey, it's a recession, prices are higher. What if people are out of money at this time? Well, if you look at credit card debt, it's at an all-time record high. Are we going to have a soft landing? I think the odds are against it with everything I'm giving you now. I don't see people raising prices anymore. I see people trying to find value and build in value to try to bring in people. I see jobless numbers increasing going into the future. Okay, jobless numbers. So if that happens, then we will start to be in the throes of this. But here's the long and short of it. It's usually within 100. The 100 days is usually the midpoint of when the recession starts, about 3 months. So 3 months from now will put us to the end of the year, going into January. January on could be very, very, very bloody for us in the markets. All right, now we're looking at the broad markets as a whole. So what should we be thinking? We're at all-time record highs here. You can see this on the Spider Daily, but this is what's interesting right now. You'll see I have a lot of lines. Why do I have a lot of lines? Because of how complex the markets have been here recently. That complexity, we have to use a lot of technical analysis to really see what's happening. The bullish part is we rallied higher Thursday. I mean, we were in a lot of trouble starting off the week. I mean, it was brutal, guys. So we had on the 18th, on the 17th, 18th, big drops, and then a huge pop. We had our interest rate dropping by 50 basis points. That was expected. Friday, we dropped down, and we have these two doji looking things at the high of a leg, which could be problematic. We have a ton of support underneath. All the moving averages, all the support lines that we have. If we break this next week, guys, we're in a lot of trouble. Look for this to drop down hard to this line, and then will this line hold? Maybe, maybe not, and then it could drop down to this line. It could be a nasty little drop. However, if we stay above these areas, now that will be very bullish if we can do that and keep, especially on this trend line, if we can stay above that one and bounce, and that would be really, really bullish for the markets. Do you see increased volume at the high of a leg? that could be capitulation. Okay, let me look at it this way. You see how you go down, 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 down. You get a big volume spike at the bottom, capitulation, pop, up. You're at a high, big volume, capitulation, a big drop. So those are things that we are looking at. Okay, if we go to the diamonds, this is, again, a daily chart. Up. We get above this line on Thursday. Great. Friday, we had this big gap down, but we rallied up above that trend line. Really good that it does that. Let's see if it can stay up there. Tech stocks. If you go over here to tech stocks, huge gap up. Then a doji right next to here. Is it going to build a base? It needs to stay bullish. It needs to keep building a base here for the week and then rally. Get up here to catch its breath. Boom. A flying plateau is what I like to call it. But we're very extended to the upside with increased volume. Markets are trying to digest what is happening right now. The Russell 2000 small caps are already dropping. Usually whatever the Russell's is doing, the rest of the markets will do. Why? Because here, let me bring up, this is a mentor moment. I'm going to put on my mentor hat for a second. If you are thinking that the markets are topping out, you're going to put your money into safer things. So what are you going to put your money? You're going to put them in the bluest blue chip stocks you can do. You're going to put them in the diamonds. You're going to put them in the Dow 30. You're going to put them in huge blue chip companies, the S&P 500. You'll do that. Where will you take money out of? The risky stuff. What's risky? Smaller cap companies such as the Russell 2000. That's what I'm looking at, the IWM. IWM Thursday gapped way up, but they sold into that strength. Friday, gap and sold down, down. Sold into this. This is telling me that the markets will likely follow suit going into next week. Whatever this is this is saying that smart money is getting out of the riskier stuff, putting it in the safer stuff. This is very telling with a market top. Financials, very important that we watch this. Financials have a huge amount of resistance. You remember that M that I talked about a little while ago? We could be getting a big M right now. Up. Big spike. Okay, here's the low. Big spike of volume. Capitulation, rally. We're at the top. We're getting more volume. How do we know it's more volume? See this moving average that I have here? Look at the moving average. Volume over that. Put in the low right here. Do you see this? We get over this line right here. Do you guys see that? Then we put in the top and then we drop. So that is capitulation type stuff. The markets could be ready to not do so well here. Okay, one thing I like to do is go to a line chart. For you guys in the mentorship, especially the 401, pay attention to what this price action is showing in this trend line. We talked about that on these when drawing these. This is more advanced, guys. But I don't want to get into that. There's a lot of theories. I need to write a book on this actually. But anyway, look how we're in the apex of this triangle. We're condensing. We're losing steam up here at this high. And again, this is the banks, the biggest ETF on banks. And the question is, can we blast through it? We need to stay bullish. We need to. I'm just thinking that this is more rising wedge type formation. This has a better chance of dropping than going higher. I'm going to pull in some market indicators. Just take a look here. Yeah, I mean, this is slowing down, guys. I'd be really, really careful at this area if you were long. And we're almost starting to get kind of high on the relative strength, and we're building kind of a bearish divergence right now. Yeah, something that I'm watching for. If I go to the US dollar, this has been in the pot, guys, but look how we're dropping here, dropping. Do you have volume starting to increase? This could be putting in a bottom. This volume increase here, put in a top, and then it came down. So this could be trying to put in a bottom. Look for this to rally. That would be a big W for wow if we get this. And that will put a ton of pressure on gold, silver, precious metals, commodities as a whole, including equities, which are stocks. That could happen. Gold on the daily, all-time record highs. People will put money in gold and silver and precious metals as for a flight of safety. They see problems. They see problems in the future, and you're seeing this here taking place. As long as it can stay above that line, that's a good 45-degree angle, it looks like. And if it can stay on that 45 going higher, that's a pretty good trajectory. Pretty good trajectory. Relative strength is really high, though. Last time we got up into this area on relative strength, we had a sizable drop. Just be careful with that. And silver, if you look at silver, really, really nice rally here. This thing did really well. Really well. It's not the same power as gold, but certainly this symmetrical triangle breaking out there is looking good. Looking good. Bitcoin is up to 63,000. It had got down to 54. It's up nearly $10,000. Up, I don't know what percentage that is off the top of my head, but I think it's a little top heavy here. Look for that to pull back. If I go to a candlestick chart, you can kind of see up, 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 up. Let it pull back to this area. Nice buy area around $60,000. That's what it looks like to me. A quick look here at the monthly chart or weekly chart. If I go to weekly chart, Bitcoin's breaking through, but S&P 500, I want to look at this. For the week, we broke over a trend line. That's really powerful that we did that. Minor trend line, but nonetheless, look for this to rally higher on the weekly. It looks good. The dailies don't look so good. Diamonds broke over a trend line, really good. But again, if next week is bearish, that's going to be a bearish jab. Look for a sell-off coming into the future. If we get a bearish jab. Next week, if it's bearish, guys, this market's going to be under a lot of stress. Qs broke out last week. This week, it continued higher. The question is, will we continue higher? I'm going to look at something here. Yeah, I mean, not bad. I kind of like what I'm seeing here. I kind of like what I'm seeing. This is the higher time frame, the weekly. So the dailies are in a lot of trouble, but the weekly is saying, hey, there's a chance. I don't like the Russell 2000. Went up, we sold into those resistance areas, and this thing's showing weakness. That's a big upper shadow there. The financials, if you look at this, we continue to climb higher on the weekly, and we're in a big rising wedge though. And the reason I got these red lines here is because we got bearish divergences in the making. If you look at this, bearish divergences in the making. And so a rising wedge with bearish divergences are usually pretty bearish. So this looks a little toppy to me, little toppy. And if a quick look at US dollar, we're trying to find major support here, but we broke below this trend line. That'd be interesting. If the US dollar next week gets bullish, that'd be a bullish jab. The US dollar could get really, really bullish. If next dollar gets bullish, look for more upside. Gold, up, up, and away. Very good. Silver on the weekly, up, up. Hasn't broke through it's got some things ahead of it. VIX is only 16. I mean, there's no fear out there at this moment. No fear out there. And if I'm going to throw on a mentor moment here. I'm done with this. If you like this level of trading education, feel free to subscribe. You can always unsubscribe. It doesn't cost you anything. Give me a thumbs up. So please do that. I want to put on my mentor hat again and say that we're redoing the 101s. It's good. So what are the 101s? We have the 101 course at freeonlinetradingeducation.com or Grok Trade. And you can go there and take these free basic 101 trading education trading tutorials. There's 5 of them. There's roughly around 15 minutes each, and it makes things more well-rounded on what stock trading is. If you want to know the difference between an ETF and a mutual fund, difference between bullish and bearish, we make the assumption you don't know anything. If there's somebody you want to get interested in stock trading, the 101 course is probably a pretty good one to get started. We are making it even more comprehensive. We're doing another one, and we're building in mentor moments. Like, I'm starting to do that with my videos. I'm saying I'm putting my mentor hat, which I'm getting ready to do here in just a moment. I'm going to put on my mentor hat and share something with you in the videos and guiding people through their education. And we used artificial intelligence to help round out the education. As thorough as what it was, now it's even better. And we still kept it to 5 lessons, and they're between 15 to 20 minutes. They're a little more comprehensive, but a lot more information. Very helpful. I think these will be share worthy, these new ones that we're coming out with. We want to, have a lot of people go through these. But anyway, here's my mentor moment. Put on my mentor hat. I want to share something with you that as a educator, but more importantly as a trader and one that's been trading in the live markets using technical analysis for 27 years, I've learned a lot of things. And one of the things I've learned is that the markets are always changing. They always have a different tune, if you will, but the melody kind of stays consistent. And I realize that trading comes with clarity. And let me explain to you what I mean by that. We are inundated with a lot of information. The trading videos on YouTube, different seminars that we attend. For you who are readers, you'll buy books. The one thing that you'll find is you will become a sponge of a lot of information, but you'll notice there's no continuity between all the books. Add in the videos, add in the seminars. You will see a cloud of confusion that will take place. That cloud of confusion comes by just a mass of information. What we have found in trading is if you can find a way, a conduit, it's usually to a person. If you can find somebody that can cut out the fluff and of things that don't directly help us make money and only focus on the things that do make us money, the idea is to find that and find it quickly. For me, and I can't speak for anybody else, for me, I blew through 2 trading accounts before I needed to either quit my expensive hobby that I had or get formally educated. I decided to be formally educated. I went through a group called Wealth Intelligence Academy, Teach Me to Trade. They're not around anymore. And I was with them, $21,000 worth of education. Life Surge just came through Tampa not too long ago. One of their segments is trading, and they charge between $20,000 to $40,000. Rich Dad Poor Dad, which, so you guys, many of you know, I'm an award-winning former Rich Dad Poor Dad Robert Kiyosaki stock mentor. Life Surge is between $20,000 and $40,000, but with Rich Dad Poor Dad, the average ticket price is around $25,000 for their education. So the question is it worth it? I wouldn't be where I'm at if I hadn't done that. And it wasn't because it wasn't about the money I spent. It was about getting put with a mentor, because the mentor, and I'm going to go back to what I was saying, cuts out the fluff. If you have a mentor that's in the trading trenches every day, that's somebody you want to listen to. That was a game changer for me. My mentorship was so beneficial. I went back a second time. And that was many, many, many years ago, decades ago. For that reason, we do mentoring ourselves. We don't, write books. Don't do a lot of seminars. We don't do the other things because that's not what helped me. So it's about clarity. Remember when I was talking about the clarity? It's about when you have all this information, it's more like the more blinders you put on. You're running in a forest trying to trade. You're running, but the lights are off. It's dark. You don't see the dangers. You don't see the cliff. You don't see the trees. When you become formally educated, what happens is you start to see, oh, there's a cliff next to me. Oh, here are trees. There's a rock. You see the dangers for the first time. Mitigating risk or bypassing those danger areas is key number 1 to trading. So always remember, as a trader, risk is more important than profit. You have to trade with risk in mind. It's all about how you exit. It's all how you protect that capital. Capital preservation, money management is hugely possible, very, very important. So is risk management. So you need those principles built into a trading plan. And once you have that, you're starting to trade like a business. And that's what you want to do, is trade like a business. And just be careful, because there's a lot of great books out there. The problem with the books is they have their own opinions, And it's a collection of data that they've gotten from others. They put it together and they have that. But if you read a second book, it won't look, feel, or smell like anything in the first book. And then you start to get confused. And then you'll start to bastardize a good working system because you keep layering on different things. The more things you layer on, the more you will wait for a trade opportunity. And by the time everyone's selling, you're going to be buying because everything lined up for you. So for example, if you have 15 indicators, you're waiting for them all to line up, I guarantee you it's going to be at a peak. And when everyone's selling, you're going to be buying, and you're going to have your head handed to you. So when there's a confluence of buy signals, always remember this, when there's a confluence of buy signals, you need to be fast at pulling the trigger and getting in the trade. Those trade signals come by way of having trading rules in place, and those trading rules have to be on in your trading plan. One thing that I know, we've mentored thousands of people, and I wish I could say 100% of all of our people are great successes. They're not. We have those that come to our program that become full-time traders. They have quit their job and this is what they do now. We have others who just tread water. They just flounder. Same mentors, same education, same level of skilled knowledge, okay? Specialized knowledge. All delivered to them the same way. Some people struggle, some people highly successful. What separates the two? Discipline, emotional resolve. That's for another time. Take care. See you later. Bye. Guys, why are you still here? You just watched my video and now you're still lingering around. Might as well be with you now that I have your undivided attention. Listen, if you haven't done so yet, I highly recommend putting in a foundation of trading, your foundation of trading through a mentor. For learning to fly a plane, you wouldn't just go through ground school before you start flying in the friendly skies. What you would be doing though is going up first with your flight instructor. Same thing if you were going to learn to ride a bike, you better have somebody behind you helping you ride a bike. Surgery, you're not going to read a few books and do heart surgery. So every principle and with being guided by a mentor, let finances be this. If you're a trader, you from amateurs to professionals. Mentoring will do that for you. Anyway.